Okay? Now, again, as I've told you with some of these other chapters, a lot of this is a repeat of various processes. Now, we're dealing with long-lived assets, but you're going to notice that a lot of these same processes occur with the other cycles that we've audited already. So I'm going to really just touch on some important pieces in this chapter. It's important to know the relationship with the assets, the long-lived assets, and the other accounts. So we know when we're dealing with equipment, we're going to deal with a depreciation expense or accumulated depreciation. And then when we get rid of the equipment, we could have either a gain or loss on disposing of the equipment. And we could also have certain impairment losses as it relates to the equipment. We're not going to spend a lot of time dealing with impairment loss, but it's important to see on this slide the relationship with our assets as it relates to other accounts. Pretty straightforward. Depreciation, accumulated, and then getting rid of the asset. Now, your book talks about what is a long-lived asset. So basically, know that these are those benefits that a company has that are going to last greater than 1 year. Okay? Items that are expended within a year's time is expensed in that current period. But assets provide us a benefit greater than 1 year. And so as a result of that benefit greater than a year, we depreciate that asset or we expense a piece of it each year called depreciation, and we keep an accumulated depreciation account that you guys know of as a contra account. So we always know what that original cost was in the asset, and then we keep track of how much depreciation we have gathered on the asset during its life. And then when we dispose of it, we're going to record either a gain or a loss on the asset. Again, we have gone over this integrated audit. We're always updating our information as we get it in on any type of risk. And how can there be misstatements on long-lived assets? Now, it's obvious that probably the most common type of motivation to misstate an asset would be to show that the asset is going to be able to have a useful life greater than what it truly has. Do you guys know what I mean by that? So where an asset may have a useful life of 10 years, they might, the company would want to overstate it to say it could have a useful life of 15 or 20. What is the motivation there, guys? What would be the motivation to do that? Less depreciation, which means greater income, and shows greater assets on the books. So again, this integrated audit always keeps up with updating risk, understanding the internal controls in place, and ways assets can manipulate earnings. They change the estimated useful life and also the residual values. They can capitalize costs that really should be expensed. So we know insurance is a period cost, repairs and maintenance are a period cost, any type of taxes would be a period cost. To capitalize those costs really show a greater sense of income, greater assets, where we know we need to look to make sure those are expensed in the current period. And then basically, there are times when assets are impaired and they need to be recognized and recorded in that period. And there's a chance for companies to not want to record that impairment, and as a result, again, lower expense by not recording that impairment, and then from that, greater income, greater assets. Account for capital leases as an operating lease. How many of you all have dealt with capital leases in other classes? Anybody? None of you? Okay, so a capital lease is basically a lease that meets one of the various criteria regarding a capital lease, such as the present value of all the payments, future payments, is equal to at least 90% of the value of the asset, or something to do with the estimated useful life is if you are leasing it for at least 75% of that estimated useful life, then it can be recorded as a capital lease. There's a couple more criteria. If there's a bargain purchase for exchange at the end of it, which means you get a good deal on it, or if at the end of the period, if the asset doesn't transfer back to the lessor. Do you guys know what I'm talking about? And so as a result of those various criteria, if one of them's in place, then you need to record on the books an asset or a leased asset as a capital lease, not an operating lease. When you have a capital lease, you show that leased asset as an asset on the books and a corresponding liability on the books. So when you're dealing with an operating lease, it's just purely an expense like rent expense. Am I giving you guys a little refresher, or have you had this lately? So the problem with showing a capital lease, the purpose of a capital lease is we want to go with more the substance than we do the form of a lease, where truly if a company is getting the benefit of it, we're calling it a lease, but in all true respects, based on the fact that you're getting to utilize that asset for almost its life and you're paying for it as such, then based on GAAP, we're supposed to record it as a capital lease and show the corresponding assets and liabilities. But a lot of times companies don't want that because it's going to offset and make their ratios look bad. Okay? So that's the negative with why companies usually don't want capital leases to show up on their books. So we want to really make sure those items that are being leased, what kind of criteria they fit, because companies are going to want to show that as probably more like a capital lease, or an operating lease than a capital lease. We need to make sure that when assets are disposed of, they get recorded appropriately. And there are assets in this day and age that become worthless. And so are those assets sitting on the books, or are they being written off? And then there are times when assets are purchased. Maybe they're purchasing a business, and with that, what may come assets, are those assets being valued accordingly? A lot of times when there are purchases, you've got a big piece of goodwill, and then you've got various assets on the books. And so it's important to make sure there's a valuation that's appropriate for all the assets that are being purchased, intangible and in fixed assets. Incorrect recording of assets hidden by complex ownership structures, amortization or depreciation schedules, and impairment. So, in this day and age, there are such complex transactions that occur when we're dealing with various subsidiaries and various types of consolidations or combinations of companies, which is a whole nother host of tax. When you get to advanced accounting, it can become a nightmare. But basically, what assets are being used and who owns them? What is the ownership structure? Really delve into understanding what are assets currently that are in your rights or the company's rights. And a lot of times they want to show the assets on the books, but the corresponding liabilities or loans or whatever is owed out there, they like to keep off the books because, again, it makes your ratios look much better. So basically, how does an auditor come in and know what's normal within an industry and what's abnormal? Looking for other industry trends is always a good way to start. Looking at past ratios as to assets, fixed assets to the total assets is another good way to start within the company. And also know that, generally speaking, when companies are planning on starting a big acquisition of fixed assets, generally it's going to be documented in the board of directors meetings. So again, similar types of topics we've discussed with other cycles of the accounting cycles. But when we're dealing with fixed assets, they're usually unique and specific, and so we're going to be able to find information pertaining to those based on the planning or projections, be it through budgets or discussions in meetings that we'll be able to read the notes on. Okay, so another thing we can do, of course, is tour the various segments of the company and see what assets are sitting around and not being utilized. And then from there, go back to the financial statements to see what the purpose of that is and should it maybe be written off as an obsolete piece of equipment. Any questions on this before we move on, guys? Is that making sense so far? You guys doing okay? Okay. Also, look at the analytical estimates of how they're coming up with depreciation for assets, and look at the various estimated lives of various assets, and then go and look at the categories to know, are they in line with what generally accepted accounting principles would deem appropriate for such assets. Another thing that is important to look at, as we would in purchasing period, but are those purchases authorized? Are they valued correctly? Is the new equipment, who calculates the useful life and how is that determined? And then after a couple years, helpful to go in and redetermine the new value of an asset and the estimated useful life of the asset, because sometimes we start out at the beginning of the period anticipating the useful life to be a certain period of time, and that may be readjusted as we've experienced the asset, and just based on technology or based on just the quality of the asset, is it something that is going to continue with the estimated life that we plan on. Intangible assets, primarily the long-lived assets we're dealing with are the fixed assets. The intangible assets are those of great value, but you can't feel it and touch it, such as goodwill or trademarks. And when we're dealing with intangible assets, the key here with intangible assets are when you go out and purchase research and development, you can treat it as an intangible asset. But generally speaking, when research and development occurs within the company, it needs to be expensed. And so, confirm that the research and development that in fact is going on within the company is expensed in the current period instead of capitalized. And why do you think they do that? They want that research and development to be expensed. Because a lot of research and development is a lot of research and might not even amount to necessarily a patent or a product. You go out and purchase that patent, then you've got an intangible asset you've in fact purchased. But the research that does go on within a company, they require that it be expensed just so you're not, again, overstating your assets for something that really doesn't have future benefits down the road. Okay. Controls used for intangible assets. Always take periodic inventories to make sure they're listed in the subsidiary account or the subsidiary ledger. Again, I think we talked about that. Let's see. Tests of controls. Ways we can test that the controls are working is ask, inquire, observe, examine, and reperform. Very common types of testing. Inquire with the personnel how things are handled. Observe those controls in place are really happening. Examine and check out the documentation just to make sure someone did sign off on it and approve it. And then you can test those controls by reperforming certain pieces of the processes. Okay. Now, if we know we can trust the beginning balance, which if we've done the audit in the previous year, then we know we can trust that balance. So really, all we really need to audit are any additions or subtractions that were put into these accounts during the period. So the additions are going to be looked at based on, does the asset really exist, who owns it, and is it valued correctly? And make sure that they're all in agreement with the subsidiary ledgers. And then we can go and actually inspect the assets. So new buildings were purchased, probably a good idea to go and physically check out the asset to make sure it is what we're seeing it is based on the documentation. This is an interesting point, and I think it's true. A lot of organizations, when they purchase assets or acquire them, there are a lot of great controls in place. But when assets are disposed of, usually they don't have the same intensity in regards to controls for disposing the assets that they do for purchasing those assets. So what guidelines are in place for getting rid of equipment, making sure they're taken off the books? Are we getting the best value or dollar we can for those equipments that we are no longer utilizing? Check out what's being treated as a trade-in. Make sure, again, documentation on paperwork is helpful. And again, inquiry. Talk to the necessary personnel just to make sure what assets have they decided to remove, and to make sure it has been removed from that subsidiary ledger. When we're dealing with write-downs in assets, important to discuss that. That, again, is something that can be subjective in nature. We're not necessarily experts in the processes of a company, but we need to make sure those financial statements are not materially misstated as we're dealing with assets. And especially when you're dealing with new technology, that's where certain types of machinery in a plant might not necessarily be beneficial for the production because there's new technology out there. How do you value impaired assets? I'm not going to even go here with impaired assets. We're not going to focus on that. I'd rather focus on any gains or disposal on assets. But know that there is ways of looking at impaired assets. That's about all I want you to be aware of. And of course, when you're dealing with companies, it's important to know what operations are getting discontinued, and then associated with that would be the write-downs of the various assets involved with those operations. Any questions right now, guys? How you doing? Good?